The idea that the Bitcoin halving drives the 4-year cycle is the single biggest myth in all of crypto. And if you're still using that myth as your map for this market, you're about to walk off a cliff. The truth is, it was never the halving that drove the 4-year cycle, but a liquidity echo from the 2008 financial crisis that was completely shattered after COVID policy response. And in this video, I'm going to prove that to you, walking through all the evidence that shows conclusively that the 4-year cycle is dead, and we're about to head into crypto's first ever 5-year cycle. So really quick, for those who aren't familiar with what the 4-year cycle is, basically every 4 years on the dot, crypto has gone through an insane parabolic bull run and then a devastating bear market right after. The first major crypto bull run mania kicked off in 2013. The second one kicked off exactly 4 years later in 2017. And then the third major crypto bull run mania kicked off exactly 4 years later from that date in 2021. And alongside this, the first major crypto bear market kicked off in 2014. And exactly 4 years later in 2018, the second major crypto bear market kicked off. And exactly 4 years later in 2022, the third major crypto bear market kicked off. And with a pattern that consistent and that strong, you can see why a lot of crypto traders follow the 4-year cycle religiously, because historically it's been accurate 100% of the time. And that's just a really difficult thing to ignore. And because of this, and based on the 4-year cycle, you have a huge group of traders right now who is planning to exit the crypto market, because the 4-year cycle, 4 years after 2021, would be 2025. So this would be the parabolic run-up phase of the market, meaning that in 2026, based on the 4-year cycle, it would be the devastating bear market phase of the crypto market. And the wide-held belief behind why this pattern exists is that it's driven by the Bitcoin halving. And this is something that I also used to believe. And the way it goes is that every 4 years, Bitcoin's emissions get cut in half. The way that the Bitcoin network attracts all these miners to spend a lot of money on electricity and build out all this infrastructure is through network emissions. Basically, you're rewarded with Bitcoin for running this infrastructure. And every 4 years, the amount of Bitcoin that you're awarded for mining Bitcoin gets cut in half. For example, when Bitcoin first came out, miners were rewarded with 50 Bitcoin every time they mined a block. That's the equivalent of like $5 million today, but back then it wasn't very much money at all. However, 4 years later, after the first halving, miners were only rewarded with 25 Bitcoin every time they mined a block. And today it's around 3.125 Bitcoin. And the idea is, which maybe makes some sense early on in Bitcoin's life cycle, that going from 50 Bitcoin rewards per block to 25 is actually a pretty big jump in issuance, meaning with less supply coming onto the market, it's very natural for Bitcoin's price to appreciate because there's less sell pressure from these miners. However, there's two big glaring problems with this theory. First off, the halving has diminishing impact as time goes on. Going from 50 to 25 was a pretty massive jump, but going from 6 to 3 is a lot smaller of a jump. Secondly, as I pointed out many times before, back in 2022, Ethereum went through this thing called the merge, and it was basically like a mega halving event where emissions weren't just cut in half, but they were cut by like 99%. And based off that, and based off the supply and demand theory of the halving, that would mean there's a lot less supply of ETH coming into the market with sustained demand. So you should see a massive pop in Ethereum's price, especially relative to Bitcoin, considering Ethereum is so much smaller than Bitcoin. It's a lot easier to move up in price. However, this is the ETH to Bitcoin price ratio. Basically, it compares ETH in terms of Bitcoin rather than US dollars. And you can see from that moment on, ETH was basically down only, which in my opinion, beyond a shadow of a doubt, proves that the Bitcoin halving almost has no effect whatsoever in driving what was causing the 4-year cycle. Because if that was the case, then why didn't it have the same effect on ETH, especially considering the ETH halving was so much larger than the typical Bitcoin halving? The reason is, of course, that the 4-year cycle has almost nothing to do with the Bitcoin halving. And instead, these 4-year bull runs were driven by huge bursts every 4 years in year-over-year liquidity. For example, as I've shown before, 2013 had strong liquidity, strong real rates, strong business cycle and credit, and opened up a ton of new access and flows. And this came from the fact that the US Federal Reserve launched its third round of quantitative easing in 2013, buying $85 billion per month in Treasury and mortgage bonds to inject cash into the financial system. This made money cheap and boosted risk-taking. At the same time, the Bank of Japan launched quantitative and qualitative easing, their own massive stimulus program to weaken the yen and pump liquidity into the markets. Together, the US and Japan created a global flood of liquidity, lowering real yields and pushing investors to take risks. And like I like to show all the time, you can see that on this chart where you have this huge burst in year-over-year global liquidity. At the same time, you had an expansion of access and flows where China China opened banking and payment access to Bitcoin for the first time, allowing Chinese retail money to flow into Bitcoin via exchanges like Bitcoin China, etc. This new on-ramp gave global capital an easy entry point into crypto. Mt. Gox, the largest exchange, then also amplified liquidity by letting anyone trade across borders. So you had abundant liquidity, neutral price of money, neutral risk, a huge growth pulse in terms of the ISM. Policy was set towards easing, market structure was neutral, and narrative and access were also strong. And speaking of the ISM in the business cycle, you can see clearly that it was heated and doing well. Everything that I just outlined is a perfect recipe for risk assets to go up. If you throw that cocktail mixed together, it is like ridiculously hard for risk assets not to go up in that environment. And all of these things happen to come together and converge in 2013, which is why we saw that first insane bull run in crypto. And as pretty much all easing cycles or business cycles, etc. go, they're often followed with tightening cycles. And what we saw post 2013 was that the Fed announced it would start tapering QE in December of 2013, meaning it would gradually reduce those bond purchases that instantly tightened global liquidity and strengthen the US dollar. And if you guys don't know how dollar strength affects markets, if dollar strength going up tightens liquidity and is really bad for risk assets, dollar strength going down loosens liquidity and is really good for risk assets. So when you strengthen the US dollar, that is a recipe to have a risk off environment or to see prices in risk assets like crypto, altcoins, etc. go down. At the same time, the People's Bank of China suddenly banned banks and payment processors from handling Bitcoin transactions, cutting off the main fiat flow channel. Then Mt. Gox, basically their Coinbase, Binance, etc. at the time, ended up collapsing in early 2014 due to insolvency, wiping out confidence and triggering forced liquidations. And speaking of that break, this is what happened after 2013 in terms of my 7 Dials dashboard. In 2014, you can clearly see liquidity impulse drops to neutral. The price of money becomes a massive headwind. Risk transmission and growth pulse stay pretty strong. Policy glide path drops into neutral, but market structure becomes a headwind and narrative and access goes into caution. Okay, so 2013, clear market easing conditions that drove risk assets, and then clear tightening conditions that caused everything to collapse. 2017, exact same thing. In 2017, you had the European Central Bank running large-scale bond buying, about 60 billion per month. You had the Bank of Japan continuing yield curve control, promising to keep the 10-year government bond yields near zero. You had the US dollar weakened by about 10%. Remember, the US dollar weakening is extremely bullish liquidity and it's extremely bullish risk assets. Global growth was also synchronized at this time. Almost every region was expanding at once, which fueled risk appetite and cross-border capital flows. At the same time, you had new access and flows. So Ethereum's ERC20 standard made it easy to create new tokens, igniting the ICO boom. Billions of dollars flowed into new crypto projects, acting as fresh liquidity. You also had the invention of perps, like those at BitMEX from Arthur Hayes, which allowed 24/7 leveraged speculation, a major amplifier both up and down moves. And then you had all the global exchanges like Coinbase, Binance, and all the Korean exchanges that made it really easy for the first time ever to access crypto. And I actually started in 2017, so I remember this. Like I could actually use Binance back then, and it made it really easy to go and buy all these tokens. And as you can see, liquidity in 2017 was actually even better than it was in 2013. The way these colors go is the black dot's the worst, the red one's bad. The orange one is caution, the yellow one's neutral, the green is supportive, purple is very supportive, and Pearl is max bullish. So you can see liquidity was very supportive. Real rates were looking great. Business cycle and credit was very supportive, and access and flows was just maxed out. And if you look at global year-over-year liquidity, you can see really, really clearly that there was a huge burst in year-over-year liquidity, meaning there was just an absurd amount of liquidity sloshing around the global market in 2017. And you can see this also on my 7 Dials framework, which weighs things a little bit differently, but liquidity impulse was looking great. The price of money was better than 2013. The risk transmission was better than 2013. Growth pulse was way better than 2013. Policy and glide path was neutral versus 2013, which was actually a little bit stronger in that category. But market structure and plumbing was way better than it was in 2013. And of course, narrative and access, the direction of money, was superior as well to 2013. And as you can see on the ISM chart, the business cycle was also peaking in 2017 in perfect sync with this bull run. And in 2017, there was also a clear driver that caused the market to collapse. In December 2017, CBO and CME launched Bitcoin's futures, giving institutions a way to short or hedge crypto for the first time, effectively a new off-ramp for liquidity. The Federal Reserve hiked interest rates 4 times in 2018 and began quantitative tightening, or QT, meaning it stopped reinvesting maturing bonds, draining liquidity. The ECB ended its QE program in December 2018, removing another source of major flow. Growth slowed in the business cycle. The US dollar strengthened. Again, that's liquidity negative. That's really bad for risk assets. and credit spreads widened. Classic liquidity drain. And if you look on my 7 Dials dashboard, you can see that 2018 was just absolutely abysmal. Liquidity pulse was a headwind, price of money was a headwind, risk transmission was a headwind, growth pulse was in caution, policy glide path was a headwind, market structure was in neutral, and the narrative and access was a headwind. And that brings us to 2021, which also had a really clear easing cycle in a really clear tightening cycle. First off, during COVID, the Fed pumped $120 billion per month into markets through asset purchases. The US government ran trillions in fiscal stimulus, direct checks, unemployment boosts, PPP loans, etc. The Treasury General account, the government's cash account at the Fed, was drawn down, releasing hundreds of billions into the banking system and money markets. Real yields were deeply negative. Inflation-adjusted interest rates were below 0%, making holding cash painful and pushing investors into risk assets. Global liquidity was at record highs. Stocks, housing, and crypto all boomed. In terms of rails and access, stablecoins exploded. Over 100 billion supply by mid-2021, creating a 24/7 dollar rails into crypto. DeFi protocols and NFTs created new ways to deploy capital and earn yields, sucking in liquidity from all directions. Retail access widened. PayPal, Cash App, and Robinhood enabled crypto buying for millions of users. Institutional rails came too. Coinbase went public, and the first Bitcoin futures ETF launched, which this is different than the spot ETFs from today, but was kind of like the first step towards the spot ETFs and institutional flows that we have today. And you can see that in 2021, liquidity was like maxed out. Real rates were maxed out. The business and credit cycle was pretty close to maxed out, and access and flows was maxed out. And looking at global year-over-year liquidity, you can see there was a huge massive burst in year-over-year liquidity in 2021, massively pushing up risk assets. And if you look across this, I point this out all the time, but I still, people don't seem to get like how conclusively this proves that the 4-year cycle was driven by macro easing conditions and not the halving. You can clearly see the 4-year cycle on this chart. But this chart isn't like, there's no crypto information on here. The only, if I click this button, now there's the Bitcoin price. Without that button, there is zero crypto data in this picture. This is just all macro data. This is global year-over-year liquidity. It measures everything outside of crypto, and it just happened to perfectly coincide with every big run-up in crypto that's ever existed. And you can see that in 2021, liquidity impulse was maxed. Price of money was maxed. Risk transmission was almost maxed. Growth pulse was almost maxed. Policy glide path was maxed. Market structure was close to max, and narrative and access was close to max. And you can also see that in 2021, there was a huge run-up and burst in the ISM that coincided perfectly with the crypto bull market. And there was a clear reason for it to end. In late 2021, the Fed announced the tapering of QE, similar to 2013. And in early 2022, it started raising interest rates aggressively, the fastest that they've raised interest rates in the last 40 years, in fact, while also beginning QT. Real yields turned positive, the US dollar strengthened sharply, and financial conditions tightened at the fastest pace in decades. Credit and funding markets started to seize up, and that triggered a leverage unwind across crypto. You had the Terra UST collapse, the Three Arrows Capital collapse, the Celsius Voyager collapse, the FTX collapse. It was a chain reaction. Higher real yields drained liquidity, and everyone depending on leverage blew up. And you can see that really clearly in the 7 Dials chart, where the conditions in 2022 were by and far the worst of any bear market, where liquidity impulse was like pure extreme headwind, price of money extreme headwind, risk transmission extreme headwind, growth pulse was the worst out of all the bear markets, policy glide path was extreme headwind, market structure and leverage plumbing was extreme headwind, and then narrative and access remained neutral. Every single crypto bull run had easing conditions that lined up perfectly with those bull runs, and every single crypto bear market had tightening conditions that lined up perfectly with those bear markets. And this 4-year cycle pattern actually comes from the 2008 financial crisis, which was also the reason that Bitcoin was created in the first place. In 2008, you had this massive financial crisis that ended up bleeding over into the global markets. And because of that, you had this huge policy response to try to fix things, where the Fed jumped in, the Treasury jumped in, they printed a bunch of money, bailed out banks, made credit really cheap, and created these really easy money conditions to try to fix the problem. And directly as a result of that policy response, you had a pattern that was created that basically played out every 4 years. Now, the pattern disruptor that broke this pattern was actually 2020 during COVID lockdowns. 2020 was unprecedented in that everyone decided to stop working, stop shipping things, and just the whole world kind of hit pause. And because of that, it created this massive global financial crisis where you had to have this huge policy response which is what we saw in that 2021 bull run where you had super cheap credit. Rates were at zero. Everyone was getting free money left and right. Money printer was just like going into overdrive on basically a global scale because that's how they fix a broken financial system. They just pump it full of liquidity to keep things going and to stop things from falling apart. But as I just mentioned, all that cheap credit, all that free flowing money sloshing around created a whole new set of problems in the financial system. One of them being that inflation spiraled out of control to do the opposite policy response where the Fed raised rates faster than they have in the last 40 years, creating some of the worst tightening conditions that we've ever seen. And this major policy pivot point from that COVID era completely broke the 4-year cycle pattern and created a brand new pattern. And I'll show you exactly what I mean in this chart. You can see past cycles have been driven by these huge bursts in liquidity, easy liquidity conditions and easy financial conditions that drove this sort of retail mania FOMO, causing Bitcoin's price to go up. However, post 2022, you can see that things have been driven primarily by this institutional structured bid. And in summer of 2023 was when BlackRock first announced that they were going for the spot Bitcoin ETF. That caused a narrative bid to Bitcoin's price, where people started bidding it up in anticipation of these ETFs being really bullish and providing better market structure and access and flows to the crypto markets. As I showed in a lot of those past cycles, we had something similar where, we had Coinbase or early on it was Mt. Gox and China opening the doors. Every cycle, there's some sort of like opening up so it's easier to access crypto and more liquidity can flow into crypto. And in this cycle, what it was these ETFs. So you had this narrative bid where people were bidding up the price of Bitcoin, expecting these ETFs. Then the ETFs went live. And then you had these like massive sustained flows into crypto, primarily not actually from institutions, but primarily from retail, but a segment of retail that hadn't previously been able to access crypto or just it was too complicated for them. And that's the older generation, the boomers of the market. They hold by and far the vast majority of the money, trillions and trillions of dollars. Where primarily before this, it was like millennials and like the poorer generations that were bidding up the price of Bitcoin. But finally, these boomers were like convinced it's time to jump in because Larry Fink and everyone on CNBC is telling them, hey, this is the future, tokenization. You should put, X amount of your portfolio into Bitcoin. Their financial advisor that they're sitting down with is saying, hey, you want to allocate some into this Bitcoin ETF? And so they're taking a portion of their portfolio and they're allocating it into Bitcoin, which is where you're seeing these flow-based bid into crypto, which is a lot different structure and type of flow than a retail-induced mania that comes from these huge bursts in year-over-year liquidity. And in fact, the institutional bid of crypto, this says institutional structured bid, but that's not quite the case. I'm talking like the institutions that have trillions and trillions to invest into crypto. That hasn't really even started yet. You're going to see that ramp up starting in 2026 into 2027, 2028. Like that just gets bigger year over year over year. But obviously what most people are just seeing is Bitcoin's at all-time highs. It kind of feels similar, markets now crashing at the end of 2025 and they're like, oh my gosh, this is the 4-year cycle, it's over. But that couldn't be further from the truth. Yes, we are at all-time highs, but it's not been driven by financial easing. It's been driven by structured flows. And then you might be saying, oh, what about the stock market? The stock market's also at all-time highs. What's the deal with that? Was that, that can't be structured flows from these Bitcoin ETFs. The reason the stock market is at all-time highs right now is primarily driven by AI and AI build out and the narrative mania around AI. If you actually look at it, like most of the stock market's gains comes from just like a small handful of companies, primarily in AI and in some cases robotics. And so again, that's a narrative bid that's been bidding up the price of that in anticipation that that's going to pay off because it's like this once in a lifetime world changing technology, which is true. And I'm going to have a video coming out soon where I'm going to really dive into that and why that is actually the right choice for the market to bid those things up to the moon, because this technology is so revolutionary and transformative that it's going to reshape everything. And again, I'll get into that into a future video where I really dive into where the market is going from here, which I have a really strong conviction that it's going to be absolutely unhinged and insane. But as I pointed out before, if you look at the ISM, right, you see 2013, you see 2017, you see 2021, and you see nothing like that today. Like that's your first pattern match. Is in the past cycles, you've had huge run-ups in the business cycle, which haven't happened today. We haven't seen anything close to that in this cycle. So that's your first like head scratcher moment of like, wait, so this is a little bit different than past cycles. The second thing is if you look at the big bursts in year over year liquidity, you had 2013, 2017, 2021. And again, you haven't seen anything similar. It's been more like a liquidity desert up until today. So that's your kind of second head scratcher moment saying, hey, well, this is different than past cycles. The third one is if you actually look at the conditions that we're in today on a macro front, you can see that we're in either neutral or caution. And really the only thing that is sitting like pretty close to what it was in past cycles is access and flows. As I pointed out, those the Bitcoin ETFs have provided unprecedented access and flows into crypto. But outside of that, macro conditions are either neutral or poor. So that's your third head scratcher moment. And if you look at my 7 dials dashboard, you can see that up until this point, not only right now, but 2022, 2023, 2024, and 2025, none of them have had the conditions present to even remotely match what we've seen over past cycles. It's either been neutral or negative conditions because the policy response after inflation went out of control in 2022 was so intense. Like it was such a quick switch from financial easing, like the unprecedented financial easing, to unprecedented financial tightening, that it's just taken a long time for the markets to recover from it. And we've just kind of been stuck in this kind of poor market environment ever since. And finally, you add the fact that if you've been around for a few cycles, you can feel that the market is different. There's a reason that everyone is scratching their head saying, man, this cycle is just the worst. And like, I don't understand, like, why didn't alts run this time? And like, everyone's like, oh, alts did run if you look at this, this, and this. And you're like, yeah, but that's not true because like I've been a part of crypto bull runs before and this like distinctively is different. It's not the same thing that we've seen in the past. And yeah, of course, every crypto cycle is a little bit different, but this one feels radically different. Like everyone was expecting a run up into the end of the year. Instead, we got this massive liquidation event and collapse. And then other people are saying, oh, it's a liquidation event, a collapse. This is similar to FTX or like this is similar to Luna. Like we've seen this before. We know what happens next. But are you sure? Are you sure when nothing else lines up to the 4-year cycle? And you can see like concretely that every other 4-year cycle had these specific conditions that lined up exactly. And this one doesn't. Like, are you absolutely sure that you're going to just base your entire investment thesis off of this 4-year clock that like nothing else lines up except for the halving? We have not just gone through a like unprecedented easing cycle. We have not gone through any sort of easing cycle. We're at the tail end of a tightening cycle, about to head into an easing cycle, which the easing cycle should take place at some point in 2026. That's when we're going to start seeing financial conditions improve, cheaper credit, more abundant liquidity, the business cycle starting to heat up. All of that takes place in 2026. We have 2 more rate cuts this year. We have potentially 3 rate cuts or more next year. We have changes to the ESLR, as I've talked about. We have continued expansion of flows and on-ramps into crypto products, more institutional adoption and involvement. We have corporate tax cuts. As rates come down, we have literally trillions in money market funds that are going to have to go seek out risk in the market. And I'll talk about this more in my next video, but you have this massive debasement trade where like all these central banks are pivoting to running it hot, to stimulating, cutting rates, etc., going into 2026. The point is that the easing cycle is ahead, not behind. So we're not heading into a tightening environment, we're heading into an easing environment. So you have to make a decision of like, am I going to sell based off this halving and just the 4-year cycle pattern without accounting for all the macro conditions and easing conditions that lined up perfectly with those events? Or am I going to take a look at the whole picture, which is not at all pattern matching to the way things have been done in the past? In my opinion, this is going to be crypto's very first 5-year cycle. And it's even possible that it goes beyond that. There's a 6-year or 7-year cycle. I don't know. All I know is we're heading into easing conditions. Easing conditions are where the action happens for crypto. And in my opinion, alt season, retail onboarding, and all that mania is still ahead and the best is yet to come. And if you're curious about seeing my entire portfolio or you want to see every time I buy and sell various tokens, as well as different weekly video market updates. Currently, the Obsidian Council is closed to new members, but you can sign up for the waitlist in the description of this video. As always, none of this is investment advice. None of this is me telling you to do anything with your money. I'm clearly not your financial advisor, and you should always do your own research. If this video was helpful, make sure to hit that like button. And if you want to see more videos like this, make sure to hit that subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.